toast of the market today is the Nifty Bank, and it has hit all-time highs. All three banks that reported numbers over the weekend, HDFC Bank, ICICI Bank and Yes Bank, are growing in the right parameters. Higher deposits, higher margins, higher ROAs, return on assets, and correctly showing lower metrics on the appropriate ones, lower costs, cost to income, and lower NPAs. Joining me to discuss the numbers and give us an idea of whether we should be buying back bank stocks at their all-time highs for the Bank Nifty is Santanu Chakrabarti, the India Analyst BFSI at BNP Paribas. Santanu, good morning. Thank you very much for sparing time for us. I want to start exactly with this question. You know, the margins have risen now, but it is very clear that there are going to be 2 more rate cuts in the very least, given that inflation is expected to be below 4% for all the months of 2025, or almost all the months. So do you think this lifting of the pressure on margins is temporary? And again, in the current quarter, we are going to see margins dip?
It's interesting you bring that up, Latha. I would invite you to think about this in a slightly different direction. If you look at what is really leading the entire easing that's going on within the space and what has really changed things, more than the first rate cut, it has been the backstopping of liquidity by the RBI that the system has proved the most sensitive to. Now, put yourself in the shoes of the RBI for a moment. Right now, there are external global uncertainties that we are looking at in terms of where tariffs will settle, whether that creates global inflation. Yes, one would expect US rates to come down, but there is an outside chance that it could go the other way as well. Now, if I am RBI and I can achieve my objectives through an instrument which is more flexible like liquidity, my immediate need to go for further rate cuts on an accelerated basis is probably not as high. It's only when the system stops responding to the primary instrument, which is liquidity, do I need to make further monetary realization. So I think probably the rate cut trajectory that is now being talked about, and remember the picture was very different even 2 months back, is now probably a slightly more accelerated timeline that people are talking about. We would expect slight pauses. Secondly, even if rates get cut more, over the next 6 months, you have to keep in mind that the easing factors have already started to kick in. HDFC Bank, for example, have cut FD rates by 50 basis points. Their savings rates is down to 2.75. So as the rate cut cycle progresses, the tailwinds on liability side continue to accelerate. So future rate cuts do not impact margins, point for point at the same level that they do in the beginning of the rate cycle. So both of these things combined, I would say that on margins as well as earnings growth for FY26, we would remain fairly constructive.
Okay. So you're saying that margins have bottomed and that they will inch up or stabilize at current levels?
Yes. Now, if I get 2 rate cuts within the next 6 months, maybe there could be another 5 basis points. I think the probability of that happening is low.
Okay, well, I can tell you a lot of people are on the other camp because obviously the real rate, the difference between inflation, 1-year inflation and current repo rate is more than 200 basis points. And there are a lot of people who will argue that it should be lower. Okay, what about loan growth? Of course, the HDFC Bank loan growth is low for a reason. It's by strategy. But ICICI Bank also said that they were very careful with their loan growth. So do you think even if your margin per product is good, the volume is not going to take off so much?
No, Latha, this is where we have to look at what, again, the liquidity infusion by RBI has done. Fundamentally, as we know, liquidity transmission is also a factor on credit growth. So we are already getting much more sound outlook bites from management in the current quarter, and even the pre-quarterly releases, now the releases, we are getting better numbers than we would have probably expected even in February. So something has changed in March. And I would actually call for something like 13% system credit growth for the full year, which we have been calling for, which is not a low number. And it would translate into mid-teens or slightly better credit growth for most of the top banks. I mean, once again, HDFC Bank is a slightly different kettle of fish, but
No, but they
broadly,
have
those are
said,
healthy numbers.
no, I'm interrupting for a reason. HDFC Bank said that they will be with system credit growth in FY26 in the con call.
Yes, yes, yes. And that has been their stance for the last three con calls, actually. So they would be on system credit growth. But I'm saying for HDFC, for ICICI, for Axis, and all the other large banks, you will be 200 to 50 basis points above credit growth,
Okay.
would be our expectation.
Okay. So you're on a buy side on all these banks?
So HDFC, ICICI, and Axis was my pecking order, as you know. But ICICI, has accelerated a little faster than others, even though HDFC has. So the amount of upside available on ICICI is definitely less than HDFC and Axis, in our opinion. But what you have to keep in mind, Latha, is the vulnerable situation that the global economy is in. If for some reason the flip side of what we believe to be the easing argument plays out, then ICICI is a lot more insulated than the other two. I mean, they are obviously higher beta, HDFC and Axis as things stand today. And that's why our ordering remains HDFC, ICICI, Axis.
No,
And we
what you're
remain
saying is
fairly
if
bullish.
rates are cut rapidly, maybe even they go to 5-quarter repo rate, then
Right.
ICICI is better placed.
No, I'm saying that in case they have to pause rate cuts,
Okay.
if some of the liquidity interventions have to be wound back because there's global inflationary pressures or something like that, and there's more selling in India, if a scenario like that works out, ICICI is better protected than the other two.
Okay. No, actually, the arguments we are getting from economists is that there is a global disinflation. Not global, there is a Asia disinflation already underway.
Right.
I mean, all Asian central banks are cutting rates, and plus Chinese goods that don't find a home in the US are going to look for home elsewhere. So disinflation is the theme that all economists are running with. Therefore, do
Right.
banks become stronger buys or weaker buys now in India?
So generally, that should make banks a stronger buy, because the rule of leverage is that inflation decays leverage, and slower inflation or deflation would obviously give you greater value for leverage. And fundamentally, a lending business is just an asset ownership of leverage itself. So
Okay.
that part is fine. But the little thing that you have to keep in mind, Lata, is that there's also US inflation that you have to keep in mind, which matters in terms of US monetary policy, and therefore the carry trade, and therefore
Yeah.
the degrees of freedom that India has on policy interventions.
No, I agree with you. We are entering into uncharted territory where you're going to perhaps see US inflation and Asian disinflation, and maybe uncharted territory in terms of interest rate differential between the two regions. But that discussion for another day. Let me come to the
Right.
banking sector and how much you can extrapolate this to the other banks. I mean, Yes Bank also has reported good numbers. So would you want to bring that in the coverage? And are you therefore upping your forecast for any of the banks that's yet to report, like, say, Kotak, IndusInd, RBL?
So, I mean, in general, we prefer not to intervene into quarterly forecasts so close to the date. But obviously, Lata, one thing I want to make clear, that these margin numbers that have come out for both of these banks were not a surprise for us. We were ahead of consensus on NII on both of these names, and it's come in line with what we were expecting. Because, for example, the classic case is HDFC. I mean, you know this very well. I've been making the case for a counter-cyclical and somewhat counterintuitive benefit of easing for HDFC Bank, quite simply because the expiring liabilities, whether they are legacy NCDs or legacy TDs from the parent, are such high cost that it really doesn't matter much what you refinance with. You will always get a positive carry trade on those. So as far as margins are concerned, we have generally been slightly more constructive than the street, and I don't see a need for an intervention right away. We would rather reassess once all the numbers are out.
Well, one of the dramatic developments of the last 2-3 years has been ICICI overtaking HDFC Bank on several parameters, notably, important for investors like ROA. Do you see that continuing, or do you think that as HDFC Bank puts behind these long-term deposits that you're talking about, can it get its mojo back to the same ROAs as the best in business?
I think the same ROAs will come back, but the composition in terms of how much margin and how much cost to income is going to be very different. This is now a lower margin and a lower cost bank, and in steady state, and that's what is going to play out. So, will you get back to 2% ROA? Absolutely, and that is what our thesis on HDFC Bank has been predicated on. Now, just taking a slightly broader view on this, HDFC Bank is still the number one liability franchise within privates in the country, right? The way I have put it always is that yes, HDFC Bank has the more powerful engine vis-a-vis ICICI Bank, but HDFC Bank balance sheet is a truck while ICICI is a car. So pound for pound, ICICI has the cost advantage on borrowings. And even if I load in, appropriate retail scale and operating costs, it is very clear to us that ICICI is the leader as far as fully loaded cost of raw material goes in the sector. And therefore, their re-rating, gain of market share, ability to make enough ROE without taking too much risk is absolutely the sector benchmark right now. In HDFC Bank, I am saying that yes, it is a truck, but the truck's getting leaner every day. So on a relative basis, given where valuations are, once ROE reverts back to, say 2% and 17% over a few quarters. Now, how fast that happens depends on how fast CASA accelerates. It could happen by early 27. It could happen at exit FY27. It will depend on the liability trajectory. But once it comes back, then multiples will also re-rate back towards that. That has been the thesis.
What are your price targets for both?
I had for the longest time the highest target price on HDFC, and ICICI I still have about 22% as of the last close. I guess it's moved 1-2% today. But remember that all my target prices currently are set on third quarter of 27, right? So once the numbers are out and we'll review, then by mechanics there's a quarter of compounding that gets added.
Okay, we'll have to leave it at that, Shantanu, but I'll take a rain check from you to invite you after all the major results are out, including Kotak and SBI and the big public sector
It'll be my
banks.
pleasure.
Thank you very much for joining us. We have to wrap up on Bazaar on that note. Markets gung-ho at this point in time, especially Nifty Bank and the mid-caps. Chartbusters will take the action forward after the break.